You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate and self-storage expert Kris Benson. Now, Kris is a managing principal with Reliant Investments, a subsidiary of Reliant Real Estate Management, which is a top 30 operator in the self-storage space. Now, Kris spends his days overseeing investor relations as well as equity contributions slated for Reliant's portfolio's expansion. Now, in today's show, Kris and I are going to hit on a variety of topics ranging from where we are in the current real estate cycle, the pros and cons of raising capital via a deal-specific syndication versus a fund structure. We're going to talk about vertically integrated management versus outsourcing. We're going to talk about finding opportunities even in today's competitive environment. And we're also going to chat about what value add really means in the self-storage space, guys, and much, much more. And so with that, I'm super excited to get onto the show with Kris. But before we do, just have a few quick housekeeping items I'd like to run through. First and foremost, I always like to share my one personal best and one professional best from the prior week. Now, starting with the personal best, this past weekend, my wife and I, we threw a surprise birthday party for her mom who just turned 65. We did that at our house, our new home that we just finished building not too long ago. We invited a ton of her friends and her family to the house, and we just had a wonderful celebration. Her mom came in and was super surprised and literally broke down crying tears of joy just seeing all her friends and family that came out to celebrate her 65th. So it was a very good weekend, lots of fun. And again, we had the opportunity of actually entertaining here at our new home, fairly recent home that we just moved into, beginning of this year. So as far as professional best, this week will mark week 2 of our national property tour. Now, we recently made the decision to bring our property management back in the house, and I'm going to be personally conducting an on-site inspection at all of our communities over the coming weeks. Now, this week, I'm going to be visiting our parks that we own in Iowa, Kansas, and Oklahoma. A few weeks ago, I was in Michigan and New York, and in the coming weeks, we're going to be in a number of other states. We currently own mobile home parks in 13 different states, and so I'm going to be making stops in each and every one of those states at those communities here in the coming weeks. Now, I'll say that I always enjoy my time on the road visiting our communities. I don't like being away from my family for extended periods of time, but, work calls. And so I got to get out there, get boots in the ground and really see what's going on there as we bring this back in the house. And by no means is this business a passive investment. In fact, most real estate, even though people say they want to own passive investment real estate, about the only time you can be passive is if you're a limited partner. If you actually are the general partner and you have a real estate investment company and you own different, whether it's apartment communities or mobile home parks or shopping centers or office buildings or any of the above, self-storage like we're going to be talking about today, it's by no means a strictly passive investment. Again, unless you're on the limited partner side. If you're on the general partner side and you're running these investments, then you're going to have your hands in the daily grind of things. And so one of the cool things I'm going to do while I'm out on site is I'm going to be going live on Facebook during my tour. I did this a couple weeks ago. I actually went live at the multiple different communities I visited, and so I'm going to do this again. So if you're not friends with me on Facebook, be sure to send me a friend request, okay? You can just find me by my name, Kevin Bupp, and that way you can check out the live tours that we do. In fact, one of the cool things that I was doing is with my drone, I can do a Facebook Live with the drone flying in the air, and I'm going to be doing that with all the different communities that we visit here in this week. And so real quick, before we get on with it, if you guys love what we're doing here, please take a minute to subscribe to the show and leave a rating and review on iTunes. And like I do every week, I like to give a shout out to someone that's taking the time to leave a review. And this review is from Dave Olson. And Dave says, Kevin's podcasts are very informative and provide great value to any investor. He covers a multitude of investments like storage, mobile home parks, RV parks, and the typical topics like apartments and housing, etc. I can promise you, regardless of what your business idea or investment plan is, there is value to be found from Kevin. All right. Well, Dave, thank you so much for taking the time to leave that review. And guys, again, these reviews really help us grow the show and help us reach more people and reach more awesome guests like Kris that we're bringing on the show here today. And lastly, before we get on with it, like to remind you about the free 30-minute phone call that I do each and every Friday. You can go to kevinbupp.com to get signed up. Just one disclaimer, you got to include some detailed notes of what you'd like to chat about during our call together. So when you set that appointment on my calendar, it gives you the opportunity to put some notes in there. Be very specific so that we can best spend our 30 minutes together, okay? Again, go to my website, kevinbupp.com to get signed up. And now, guys, without further ado, let's get on to the part of the show that you have been waiting for, which is our interview with Kris Benson. So here we go. Alrighty, guys, it's my honor to introduce my guest for today's show, self-storage expert, Kris Benson. Kris, how you doing today?
I'm doing well, Kevin. Thanks for having me.
Yeah, thanks for joining us here. And just to give our listeners a sense of geography, tell us where you're based at here today.
Yeah, for sure. So Reliant's corporate headquarters is in Roswell, Georgia. We're just outside of Atlanta, kind of the northwest corridor for those of people who know Atlanta, outside the perimeter, Fulton County. So 25 miles from the airport. Add traffic to that, we're probably an hour.
Alrighty. Fantastic. So give us a little bit of your background. For those who aren't familiar with you, not familiar with what it is you do at Reliant, what the company is all about. Give us that 10,000-foot view of both Kris Benson himself, but also Reliant as a company.
Well, the Kris Benson story is a long one. So kind of how I got to real estate. My background really is in sales, Kevin. So I had a number of corporate sales jobs kind of coming out of college. And just to summarize that really quickly, realized really quickly that I didn't want to spend the next 30 years trading time for money. I think it was the discussion that many of us as real estate investors have. I was doing, really well financially, had a fantastic career, but my work-life balance was miserable. So I distinctly remember waking up when I was, 28 and saying, I don't think I can do this another 30 years. And so that was the beginning of real estate for me. And, I started in a path not too dissimilar than probably most people, went to residential and started buying some duplexes. And I realized I hated that very quickly. And it wasn't scalable for us for what I wanted to do as far as replacing income. So we took a path where we sold the residential real estate and got into commercial multifamily. And so it's kind of a wild story, but essentially I built a 64-unit apartment complex in a town not too far from where I grew up with. Had a fantastic partner who made sure I didn't drive it into the ground on the construction background. And really that was my foray into, commercial real estate, kind of the big boy real estate world. Mm-hmm. And once I did that, the light bulb started going off. There was a quote that I love to use, and I wish I could credit who I heard it from, but I don't. So it's big deals and small deals are the same amount of work. You just make less money on small deals. And that's so true even today in what we're doing now. So for me, that was a big mindset shift where I said, okay, if we're going to dedicate time to this, we're smart enough to figure out the big deals. And to be honest, my career's really been predicated by having fantastic partners along the way. And it's no different at Reliant.
Yeah, that's fantastic. So that's very important. And you're absolutely right. It's really the same actual structure of a deal from a high level point of view is very much the same from a small duplex that you're buying to a 64 unit. Maybe not a development. Development, you can't really compare to buying a pre-existing duplex. They each have their unique nuances and caveats. But generally speaking, it really, you're absolutely correct. It really is just a mindset shift that you have to make at some point. In fact, I like to say that for the most part, larger deals, now we're talking about getting into deals that qualify for non-recourse debt and such. When we really think about it from that perspective, there's actually less risk in larger deals than smaller deals, because most smaller deals, you're going to have full recourse debt. You're going to be putting your name on the line and all your personal assets along with it. I think there's a lot of risk associated with that, especially when you start scaling large portfolios of single family properties or duplexes or, basically millions of dollars worth of recourse debt. I think there's a lot of risk there.
Yeah, I agree with you. In storage, actually, there really isn't great non-recourse debt available. So, the Freddie and Fannie that exist in the multifamily space, boy, I wish we had that.
You got CMBS though, correct?
Yeah, but the CMBS challenge for us, and not to go too far down that rat hole, is the timeline. Typically that CMBS notes that 10-year hold. And our strategy is really built around kind of that 5 to, our value add properties are in that 5 to 6 year window. We've sold 21 properties, not to jump to Reliant. We've sold 21 properties and our average hold time those is just over 3 years.
Got it.
The CMBS, that's tough because you end up with a heavy defeasance payment at the end.
Yeah, it's definitely long term. Yeah. You definitely don't want to use CMBS if the intent is to get in and out within a 3 to 5 year span or any time prior to that 10 years, basically.
Yeah. It gets expensive. There's no
let's go ahead and shift the gears. Let's get over to Reliant. Let's talk about, how long you've been with Reliant, how you were introduced to the company, what attracted you to the self-storage arena in the first place. So let's just go ahead, and that's the foundation. I'll let you run with it.
So what ended up happening after we built the 64 units, I also just kind of organically got introduced to what syndication was. I didn't even realize that world existed. I had done everything with my own capital at that point, and fortunately I had a wife who was super risk tolerant and willing to risk our life savings on things that I didn't really know what I was doing, but that turned out okay. And what happened was, once I realized what syndication was, I knew that I wasn't the best multifamily operator, but I loved the asset class. So we went out and partnered with 3 multifamily operators and invested in primary markets across the US. And what happened, Kevin, is organically my group that I was investing alongside with grew. And so I was earning back-end ownership on properties that I was bringing equity to. And so as we did that, that's where I was growing my passive income stream. It was properties I wanted to invest in. And then I brought my group along with it and would earn some equity on the back end of the deal. So that's what we did. And essentially about 3 years ago, one of those operators came to me and said, hey, I'm not buying anymore. Cap rates have compressed to a place where we're not comfortable. And so we'll continue to underwrite deals, but we're probably not going to buy. And that was a real wake-up call for me to say, maybe we should be looking at some other asset classes. And so I did some homework and fell in love with self-storage. And I'll give you sort of my 3 pillars that I use as to why I originally fell in love with the asset class. And, even to this day, why I think they're all still relevant. But I'm a data guy, so I like to look at, historical data to help make the decisions. And there were really 3 things that I looked at with storage that drew me to the asset class. And I can give you the data set. You familiar with the National Association of REITs?
I am.
So that NAREIT data is published online. So essentially you have access to any publicly traded REIT, and their data set's pretty inclusive. It's over the last 25 years. So you have a pretty good data set. And what I did initially was just went and did some comparators, right? I can see every asset class. So you can see self-storage, mobile home parks, apartments, residential, medical, office, timber, agriculture, anybody who's got a publicly traded REIT. And so storage over the last 25 years did just under 17% a year, which is incredible. And if I'm comparing that to multifamily did just under 13%, which is still incredible. But I was shocked that storage kind of outproduced the sexy asset, right? I mean, multifamily is sort of that's always the sexy asset class. You and I are the ones where everybody's like, oh, storage, mobile parts. I don't want anything to do with that. But there's a reason. So that was the first thing I looked at. And then the next thing is I'm a big believer that everything in the market that's going to happen has happened in the past. And so, for us, it was a function of looking at what had happened in the last recession and understanding how the asset class was affected. And so, Kevin, like mobile home parks, storage has some really nice resiliency. And I wouldn't say it has some downside protection. So in 2007, 8, and 9, storage lost less than 4% of its value on the publicly traded REIT space. And, apartments was closer to 7, which is what I was investing in at that point. And then, just to give your listeners a baseline, the S&P 500 was down just over 22%. So for me, then I had an asset class that had some really nice upside and some really nice downside protection, not too dissimilar than the mobile home park story, right? I think that's probably a very similar ilk. And the third pillar, and as I talk through this, you could probably say the same thing with mobile home parks. And this is where it's the reason why I'm sitting at a desk at Reliant right now is the opportunity in the future is so less than 25% of the storage market is owned by publicly traded companies. So there's 5 REITs. And for your listeners who are on the road right now, if they look out the window and they're pretty close to a populated area, they probably will see an Extra Space or a Publix. And there's 5 of those REITs. And then the 6th company is U-Haul, which everybody knows is the moving company. And they have a bit sizable portfolio. So they own about 20-25% of the market, depending on what data you look at. And the rest is still all over the board. So we don't have as many mom and pop operators as you do in mobile home parks, but we still have a bunch. And so there's a really nice consolidation opportunity for a company like us, a regional operator, that can come in and do some value add type plays from mom and pop operators or from, other regional operators a little bit smaller than us.
Mm-hmm.
We have 52 properties in the portfolio right now, and we're the 25th largest self-storage operator in the US.
Wow.
To go to top 10 is not that many more properties, right? I mean, you have the top 6 that are huge, and then after that, it drops off precipitously. So for me, there's a huge consolidation play where, a company like us to go from 50 properties to 100, we become a really interesting company at that point. Mm-hmm. From, either a roll up to a REIT, or, we're selling large chunks of our portfolio out to institutional capital. So that's the reason I fell in love with storage.
And how long have you been with Reliant?
So I was an investor first. So that's what happened is literally once I said, all right, I like that asset class, I started calling the self-storage operator list. There's a list that gets published every year, top 100 operators. And I literally called and said, hey, I got some equity. Do you need it? And if you do, will you share with me the back end ownership? And so I met with a bunch of operators, and Reliant was one of them. And Kevin, honestly, I fell in love more with the people at Reliant. I'm a big believer. I've done a fair amount of passive investing. The people are who make the returns work, right?
Absolutely.
The real estate's got to make sense. But especially in the passive space where you're really trusting the operator, I've invested a lot based on, what I think will happen with those people when things go wrong, and who they are as humans first.
That's a great point. I was having this conversation the other day. Someone that was just getting started and they were looking to invest passively. And I forget exactly how he phrased the question, but essentially, his concerns were, he does not have the underwriting skills of a lot of the sponsors that he, where he's looking at deals. And so he was having a challenge of, how do I determine, whether it's a good deal or a bad deal? And I said, first and foremost, forget about that part initially. First and foremost, it really lies with the sponsor. You got to understand who the sponsor is, what their track record is. You'll get to meet them in person, because a good deal to you and me, something that seems like fail-proof. If it's a horrible operator, that thing's going to fail, right? So it's definitely more about finding the solid sponsor, the guy that's going to do the right thing when times are tough, the guy that during the downturn is going to be, working 20 hours a day, 7 days a week to make sure that he pulls the ship through the storm. That's first and foremost the most important part of picking the right sponsor to work with. So I feel you wholeheartedly. So, and
I couldn't agree more. Like, I mean, you look at some of the due diligence. Do you know who Ian Ippolito is? You must.
I don't know.
So he always publishes articles of essentially sponsors that have gone down the tubes, right? And some of the sponsors that are pilfering money, and Bernie Madoff is kind of the example everybody knows, but these guys are big institutional capital raising companies, right? So they're not, fly by the seat of your pants working out of my mom's basement. These are big organizations that really are making really poor decisions. And so when you see companies like that are doing things not in the best interest of investors, the only thing you can trust, right, is the people part, and even that, sometimes goes wrong. But so in any event, I really fell in love with Todd Allen and Lou Pollack are the two guys that started Reliant. And Lou is in his early 70s and semi-retired, and Todd's running the operations day to day. And what I really appreciate about Todd is he's a great operator, but more importantly, he's interested in ensuring, one, it's a long-term relationship, and two, that the investor is taken care of first, right? Mm-hmm. We all want to make money. I don't mean to say that we're doing this altruistically, but he truly is not greedy, right? And you can see that in the terms of the deals that he offered. And that's one thing I would say to your listeners is also critical. Like, as you look through structures of deals, what these people are like based on how they structure their programs, right? Mm-hmm. You can see how aggressive they are based on their underwriting assumptions. And then you can also see kind of where they fit in the, I don't mean to say a greed scale, but, how they structure the deal is usually a really good indicator of what type of people they are. So yeah, in any event, I fell in love with them. We were an investor first. We invested in 2 properties. And then about 2 years ago, I was meeting with Todd here in Atlanta looking at a property, and he had said, hey, I'm having trouble raising money. And if you've ever looked at Reliant's track record, I was like, as a salesperson, that didn't compute. I was like, you have the best product to sell in the world. How are you having trouble raising money? And the answer was, they're a growing company and those responsibilities were falling all on Todd. So we worked out a partnership. And so that's how I joined Reliant. And really, my role is managing, and kind of institutionalizing the equity arm of our business so that as we're growing our portfolio, we have access to equity all along the way.
Mm-hmm. No, that's fantastic. That's a great story. I mean, it's for those that are listening that maybe just are starting their journey and maybe they're, where you were a few years back, just passively investing, in a career where they're making great money, but just have this burning desire to maybe jump into the real estate side, but are starting to do that in a passive manner. They're out there seeking out, only the best sponsors to place their capital with. And, that's how relationships form. And that's the importance of truly establishing relationships but maintaining them. I think that's the important part of it. It sounds like you probably stayed in touch on a regular basis. I'm assuming that there was value given from both sides of the equation. I'm sure that you tried to give back whenever you could. They gave back to you. And it just sounded like a great friendship formed as well. And that's incredibly important. And it's turned into something, very, very nice for you as far as an opportunity, a lifestyle change. You get to work with people that you truly enjoy, something that you have a passion for. It sounds like you didn't have the biggest passion for what you were doing in the corporate world prior. And it sounds like life is good. So it's a good story. I love it.
When you say it back to me like that, I'm like, wow, things are pretty good.
Yeah. So that's wonderful.
But I think, one thing that I could say is, and so Kevin, we probably get similar questions to people who are just starting out, like, hey, what kind of advice would you have for a person in my position? And I think part of the advice, you hit the nail right on the head, is at some point you have to do something, right? Is, you can educate as much as you want, right? But there's a point where you have to jump, and you're only going to learn so much when you're educating and reading books and listening to podcasts like yours. At some point you have to jump in. And even if you're uncomfortable, that's where you're going to do the most learning. And I think that's been something for me that every step of the way, I haven't known everything, and I still don't to this day. But if you're willing to continue to push yourself and put yourself in uncomfortable situations, usually that is you progressing. So it's
absolutely
a big standard in my career, how that's worked. And I would encourage everybody to kind of think about what opportunities are in front of you that way and be willing to jump when you need to.
So let's talk about the mechanics of the self-storage space as far as opportunities today. What does that look like for the Reliant team? What do you guys consider to be value add? I mean, even though that your space isn't fully consolidated yet, like the majority of multifamily and other types of commercial real estate, mobile home parks, I like to say that we're probably where self-storage was like 10 years ago, but we're quickly getting to a consolidation point. And the reason why ours is going a lot faster now is that there's no new supply coming on the market. So we've got like the stagnant supply that's being gobbled up. And I think there's going to be it may not end in sight, but it's we're going to quickly grow to that consolidation number, probably a little bit faster than self-storage because there's continual development in your space and things continue to trade. And in any event, talk to me about what an opportunity looks like to you guys today. Based on your size, is it harder to find deals based on the competition that's out there, not just from the 6 publicly traded REITs, but also from all the other folks that are seeing self-storage as being a sexy asset class, not just like mobile home parks. I can see personally, I've seen such a major 180 shift just over the past 12 months alone. The years leading up to that, I could see it slowly getting more competitive, owners being a lot more educated about what their property is worth, just a lot more interest in our asset class. And for the last really 12 months, I mean, it's been a significant change. Lots of PE firms diving in here, lower cost of capital than what we might have, and just make it a little more difficult to find great deals. So really, I'll let you speak now as far as for you guys.
What was the catalyst for that? Is it just additional capital coming into the marketplace?
Yeah, I think there's a couple factors playing there. I think one of the big ones is, as you had mentioned, multifamily is incredibly competitive and very overheated in a lot of markets. And I think that a lot of the firms that were investing in multifamily that probably would snub their nose at our asset class many years ago slowly started considering it and realizing the true merit behind what it is we do, and have maybe not jumped ship, but had really started putting their focus over here. For example, Blackstone just launched a $1.5 billion fund for our space about 6 months ago. So Carlyle Group's in our space, lots of other smaller private equity firms diving in. So just really not being able to find yield in other places. I mean, maybe they're currently in self-storage, they're currently in multifamily, but just never had really considered or given thought to this unsexy asset class that we have, which is mobile home parks. But now we're really understanding the merits behind it and want in. So,
and you can't make money in an asset class for too long before the institutional capital is behind you, right?
Yeah.
You can't live in that bubble forever. But and we're seeing that in storage. So to your question, I think like you on the mobile home side, storage has become a sexy asset class, and it's been proven, right? And where you see that the most is with the lenders, right? I mean, 5 years ago, the lenders, especially around development, was very, very hesitant. And now you got mortgage brokers coming out of your ears with trying to deploy capital into the space, right? And that's usually, and some of the really conservative lenders on the debt side as well, like pension funds and life insurance companies, they all want a piece. The CMBS notes, they all want a piece of storage because it's become a proven asset class, through a last cycle, right? So it's really matured as an asset class. Now with that has come a huge development cycle. And so just to give you some quick statistics, 2017 and 2018, the asset class delivered the most new net rentable square footage in the history of the asset class.
Wow.
So there's been a huge glut on the development side. And so what that's done, obviously, is added a ton of new supply. 2017, 2018, 2019 is on pace about where 2018 is going to be. And then it's supposed to trail off. The good news at this point is it's leased up. Now, it may not have leased up at the pro forma projections, right? In certain markets where, certain rent rates and growth and lease up rates were considered. But as a whole, we're not seeing a ton of, properties come back to the market from a bank-owned perspective. So the good news is the demand is supporting the supply, just maybe not with the original metrics that you had projected in your pro forma. So, go ahead.
Yeah, I was going to ask, how do you guys mitigate that risk? As far as new supply coming on the market and having at some point maybe too much supply, right? To where even if you're conservative in your pro forma, maybe you're doing expansion and yet you got a couple other projects coming in town and, there's certain things that are outside of your control, right? And I guess, are there different formulas that you guys use to determine what real risk is in a given marketplace if you're looking at an opportunity?
Yeah, so how we look at it, right? We can only underwrite until we buy the property, right?
Yeah.
3 years from now, if a development comes down the road, what do we do about that? So, we're obviously looking for opportunities that have natural barriers to entry. There's some municipalities that have put moratoriums on new storage building, right? They've seen 3 or 4 facilities pop up and say, hey, we don't want any more of these in our town, so we're not going to build those. So obviously the values there jump up precipitously. But I think for us, Kevin, it's a sharpshooter's game, right? What matters in storage is the 1, 3, and 5 mile radius around the property, right? MSA level data. So, if I'm looking at Atlanta may be oversupplied and rent rates are going down, but it doesn't matter. What matters is that 1, 3, and 5 mile window around your property. Because think of it this way, Kevin, in storage, it's a convenience business. So people are you either are on their way to work or you're close to their house. People aren't driving for amenities and storage, right? There's no school districts. Like no one's going to go out of their way for a facility. It's what's convenient to me. And so for us, it's really doing a deep dive into that intimate market. So our acquisitions team spending a lot of time on the 1, 3, and 5, understanding the current supply. And then I'll give you one thing we've been doing just to kind of protect ourselves against the future is when we get a property under contract, we get a list of the rent roll, right? So we have all the addresses of the current tenants. Well, we hire a guy from Upwork actually, who will go out and geomap all of those tenants on a map so we can see dot map where everybody is. And it's interesting to see where the clusters are. And what it does is then we can kind of overlay that to where we think development would happen if new development were to come into a market. And so then we know, okay, well, look, here's a bunch of vacant land. This is in the path of progress, but are our tenants coming from there, right? Because it's interesting. There's all these natural barriers that crop up, highways, rivers, and it's not like there's bridges or it's not like there are not bridges to cross these things. But for some reason, tenants don't go past these areas. And so it's just one of the ways that we're trying to dig into a market to understand, okay, like, yes, our hold time's 5 years and development can impact us, but based on our best guess, here's where we think development would be if it comes in. And, here's where we think our tenant base is. And so if it happens here, they're not really going to draw from here, and it's not a perfect science, right? We have markets that have been hugely impacted by supply. And, that's part of the risk of being in the real estate game. Our perspective is they're going to come back. It's just a matter of time.
Mm-hmm. That's interesting. I love the geo mapping idea. Now, have you guys ever gone as far as if you're looking at a facility, you've done the geo mapping exercise, and you see kind of a cluster on the outskirts of that 135 mile radius, and obviously there's probably no self-storage facility out there on the outskirts, and that's why you got this cluster that's coming and crossing bridges and going underneath highways to get to your facility. If the facility that you're looking at has a very high occupancy, have you guys gone as far as, number one, purchasing that facility, but then also actually developing a new where you obviously have identified that there's a demand for it? I mean, obviously you kind of sabotage, at that point you'd sabotage a little bit of, the demand for the existing unit. However, hopefully it would fill back up, but you know that there's a significant demand due to the concentrated cluster. I mean, has that ever played out?
No, not in the manner that you're describing, where we're buying a property and then developing one, maybe 2 miles down the road or 5 miles down the road.
Got it.
But we've definitely been in development situations. So our sweet spot, and I'll talk you through kind of our value add, because I know that was one of your questions, but we're just Todd's experience. He's done everything. So we've done a bunch of development. He's done retrofits. He's done value add. So we're opportunistic in that we'll look at anything. But development at this point in the cycle is risky, right? The projections you make day one most likely are going to be different than when you would try to exit this property. So the development for us is got to be home runs, right? They have to be like no-brainers, a reason why we're specifically going into that marketplace. So, I will give you an example, kind of what you described, where a guy brought us a piece of land in Naples, Florida, and what was interesting about it was based on, it had its own commercial, like infill issue. So there was nowhere else to develop except on this piece of land. And it was surrounded by a corridor where all this residential traffic had to go through this one spot. And so for us, that had its own natural barriers to development. And we knew, hey, if we build here, nobody else can build. So you can't have storage. There was storage on either side of it, like out on the outskirts of our 5 mile ring. But if you wanted to access this residential group, it had to go past. And so what ended up happening with that is we developed it, built it. We had it less than 2 years. And one of the REITs came to us and said, hey, we own the one down there and the one on this side. We want to control this whole corridor. And so we sold it. It was an unsolicited offer. I mean, we planned to hold that one long term. And, we ended up tripling our investors' money in just over 2 years. So you can't say no, right? I mean, if someone's going to deliver your returns projected in year 6, in year 2.
I was going to ask you the question, is there always a right time to sell? And I think you just answered it for me. Some people say, I'll never, ever sell, but there really is. There's always a right time to consider selling. And it sounds like that was it. I mean, that was in the best interest of your group, but not just your group, your investors, more importantly.
Yeah, Kevin, I think it's easy to say I'll never sell when it's my money.
Yeah,
if it's my money in the deal, I have a different incentive. But for us, our investors are expecting us to make the decision best for them. And it's hard to, when projected returns come along earlier than you told them, it's hard to say,
sure,
hey, we're going to wait, unless there's a really good reason, especially right now, we're in this confluence of a market where there's so much capital chasing deals and creating outliers. We just sold a 2-property portfolio in April in Florida for a sub-5 cap off T12 actuals. And in storage, at least for us, that's crazy. And, last year we sold 4 properties. In 2018, we sold 4 properties. Our average exit cap was just under 6. So this was a big shift where, there's money out there chasing. And so sometimes you gotta take that money off the table.
Very interesting. You had mentioned, is it Todd, one of the principals of the group? Is it Todd? Todd's done a lot of different projects. He's done a little bit of everything. Retrofit is one of the two. And that's something that I guess maybe it's just my path from where my office is to my home. There's a couple different retrofit projects that Public Storage is one. And I can't think of the other names of the other few. I don't think they're any of the 6 publicly traded companies, but, bowling alley was one Public Storage, retrofit this old bowling alley. There's some, anchored, an anchor from a strip center that was converted. I don't know what it used to be. It had been dark for a number of years.
Toys R Us?
No, there is a dark Toys R Us near us that has not been retrofitted yet. But I guess my question would be, you guys, it sounds like you've been involved in projects like that. Is that something that's still on your horizon today? Like, is it easier to find opportunity in those retrofit type projects than it is going after the already existing facilities where everyone else is going after the same thing, right? There's competition for the same thing. Whereas with the retrofits, that's a little bit of a different skill set. takes a little bit more of a visionary to get involved in something like that, a little bit more risk as well. But I guess I'd love to hear your thoughts and feedback as to what type of projects you've been in, and are there any on your future horizon that you intend to get involved in?
So the retrofit, Kevin, like those values have not dropped as much as you'd think they would have, especially, like the Toys R Us. We looked at a whole portfolio of Toys R Us's just to see if we could make the numbers work. And it becomes very competitive very quick because, the cost to build versus the replacement cost are, there's a big delta between the two. So they're very competitive. And we've not done a retrofit in the last 2 years. And to your point about the competitive nature, our sweet spot really is, not too dissimilar than, multifamily, where you're trying to find kind of that C property in a B+A area, right? And so where we fit in is we're sort of like a middleman for the REITs, right? Where we're willing to go in and take the execution risk on a value add. And so value add may be an expansion, right? Where we're quoting, I'll give you an example. Property we closed on in March was in Greenville, South Carolina. It's a beautiful facility, but dated. And we built are in the midst of building a 17,000 square foot building right on the highway. So we're getting that highway frontage. It's all climate controlled. It's got some mixed use in there that the municipality wanted to see some retail as well. But, we're essentially building that asset so that when a REIT or when we're in a position where we want to sell, we've created an asset that a REIT can literally go in and change the sign. We've institutionalized the asset.
What makes a self-storage facility dated? For anyone that's listening that has never been in a self-storage facility, in their mind, I'm guessing they're just visioning like a steel building, or I guess some of the older buildings were concrete with the steel doors. But it's a steel, very basic structure, a shed type structure. What is dated versus updated in the self-storage world?
I mean, there's been like 2 generations, right? First generation storage was what you're thinking about, like gravel road, rural area. There's a house in front. Some guy comes out from behind the desk with a spaghetti, right? And he'll rent you the unit. And now generation 2 of storage is, we call it in front of the gate, right? So the retail office is like a Starbucks. It's beautiful, right? I mean, it's the lighting, it's the feel when you walk in, coffee's brewing. We have a retail component where we're selling boxes, locks, tape, those kinds of things, the ancillary items that go along with storage and moving. And really the shift has been, from that rural area to now storage on the corner of Main, and you got a 3-story, all climate controlled building in prime real estate locations. And so for us, when we see a dated facility, a lot of it's about layout and kind of the flow through the property. The retail office is always a big component of it, where it is and how you can see it from the road. That property that I just mentioned, it's on a fantastic road, West Butler Road in Greenville, huge traffic count, but you can't see the property from the road. And so 30% of our tenants come from drive-by traffic. And so part of it is repositioning the asset where now, as these 30,000 cars a day are driving by, they're like, oh, there's a storage facility. I need a storage facility. And, and it puts us in a much better position from a repositioning standpoint when we do want to exit, because the REITs are all going to do that. And our play really is, look, if you want to be in this market, the replacement cost is to build it. It's going to be more expensive than buying it from us. So come in, buy the asset. It's ready to roll, and it's being operated like you're going to. So just put a different sign on the front and you can take your cap rate.
So 30% of the traffic, at least of that particular facility, comes from drive-bys. The other 70, I'm assuming, are web-based searches, right? Google. People are doing
Google searches. It depends on the market.
Okay, let's just use this one as an example here. I guess my question would be, in like an area like Greenville, which I'm assuming that maybe not all 6 of the REITs, but a couple of those REITs have locations in the Greenville market. Correct me if I'm wrong. I'm just making that assumption. Is that the case?
Especially downtown, where we bought that asset is kind of in the path of progress, where it's all pushing to. They're not quite there yet, but certainly in the primary Greenville market, absolutely.
Okay. Let's make the assumption that this one that you just bought it's near where some of the other big competitors are. Are there dynamic pricing models that allow you guys to kind of always stay like a slight tier below, what everyone else is offering? So I'm guessing, other than location wise and convenience, everyone else is price shopping. So they're looking for the one that's closest to home, but also if they could save $8 a month because they know once they put their stuff in there, it's probably going to be there for a while. They might drive an extra half mile. They might go to the other self-storage facility. And so is there a dynamic pricing model that you guys have in place or that's, within the industry that allows you to always kind of truly compete with the big dogs out there?
Yeah. So the REITs, what they use is they have their own proprietary software where their rates are changing daily based on their occupancy across the portfolio. Right. So we're definitely at a disadvantage where their pricing is fluctuating on a day-to-day basis. For us, how we're doing it is with local comp studies where we're managing based off occupancy and price rates in the marketplace. So yes, our pricing definitely changes based on what we're seeing because, obviously if a new facility opens up, most of the time they're going to drop the rates to get you in the door and then slowly burn off those discounts and concessions as they go. So yeah, it's definitely a dynamic market. And as you had mentioned, as new supply comes in, it definitely impacts where your market rates have to be to still be competitive. I would add one more thing to the convenience and price. Customer service is a big part of it as well, where, typically, your tenant coming in, when they come into the facility, they're not in the office very often, right? So once they rent, they're usually not in the office unless they're renting U-Haul trucks or something along those lines. And so the impact that your people behind the desk can have on the tenant is a big deal. Certainly in the online reviews and how they perceive the property. I think for us, one of the big shifts, Kevin, over the last 3 years has been how sophisticated we've had to become in digital marketing because we're never going to outspend the REITs, right? Yeah. We just can't. We're not going to be the number one Google hit, right? We don't have the ability to outspend CubeSmart.
Well, that's it. The who has deeper pockets wins in that game. That's really what it comes down to.
It's true. So we've had to be creative in what we've done on the digital marketing. I mean, we're doing pay-per-click ads and search engine optimization, those kinds of things. So we're on Google. You're going to be on the first page. You're part of that Google business pack. But we've also done some interesting things on the social media side with Facebook and tooling around with how we can target people because Facebook allows you to be really dynamic and specific as far as how you get to people. So it's definitely for us, one of our big disadvantages when competing with the REITs is just we can't spend the money that they can. They can definitely buy occupancy. And for us, what we try to do is offset that with managers who are doing grassroots marketing, right? Where, we have people out on the streets, chamber of commerce meetings, meeting with moving companies, apartment complexes, and out hustling to try to drive traffic to us rather than just waiting behind the desk and saying, hey, I'm an order taker. So it's kind of the balance of where we are in the industry right now.
Yeah, that's fantastic. Well, that's all exciting. It sounds like you guys have great things going on. I'm even in a very hyper competitive marketplace or part of the real estate cycle, whatever you want to call it. You guys are still making things happen. So very, very exciting. Is there anything relevant that we might have missed? I know there's so many other rabbit holes we could have gone down about self-storage. I think we covered a lot of ground here, but is there anything else related to you, related to Reliant, related to self-storage that you feel would be relevant for us to share with the listeners before we wrap it up here, Kris?
What are you thinking? Like dating profile? Like I like long walks on the beach?
I don't know. Hey, I heard you're married, man. You better watch out. Your wife might listen to this and come kick your butt. No,
I appreciate you asking. I think, from my story, the big thing I would say is be willing to jump and be opportunistic. Yeah. I mean, if this is the path you desire, whether it's from a passive income investing side of things or from you creating your own real estate path, be willing to jump and chase opportunities. And then I think the other thing is, from the storage side, it's not storage specific as much as it's cycle specific. You got to understand where we are in the cycle right now, right? And we're late, right? And, another great quote I love is trees don't grow to the sky. So they have to stop eventually. And so at that point, then there's going to be some tremendous buying opportunities. And for us, I think that's where we get excited is there's been a lot of people who've come into storage that are not storage people.
Yeah, I was going to ask you, what creates those buying opportunities? I have the same saying, and I'm seeing the same thing. We're getting a lot of folks that are getting into our space. There's lots of moving parts in our space and lots of things that exist in our space that are a little more challenging that might be in the standard multifamily space. And lots of folks buying that I feel might have some struggles down the road, and especially when they're buying at such thin margins. Is that kind of what you're seeing as well in the self-storage space?
Well, we actually haven't seen, I guess this speaks to the market. We haven't seen an REO property, like a bank-owned property.
We haven't seen any yet, but
yeah, we're kind of the same thing. But there's been a lot of merchant builders who've just gone out and built storage facilities, right? And so as soon as the pro formas don't start to do what they originally wanted, we're expecting that market to become nervous. And I'm a believer, Kevin, that, the best wealth generating opportunities are in the downturn, right? I mean, everything's cyclical. If you can see it to the other side. And I think for our investors, especially our institutional investors, they see that too, right? So, we're in the midst of doing our first fund with the goal of maybe not with this fund, but with the next fund, which, we're hoping to kind of be in that $150 million range, that we have dry powder sitting around so that when that correction happens, we can go in and get properties pennies on the dollar, right? And
go on a buying spree. I love it.
That's right. That's right.
So that day to come.
I think we're all kind of in that point, and we'll see. I mean, look, I could be wrong on this, and maybe that doesn't happen, but there's going to be some blood in the streets, and it's going to be up to us to go capitalize on that.
You only need one drop of it. Just got to go find that one then.
That's right.
Well, Kris, this has been a lot of fun. I know you've got multiple different websites that we can find you at and get more information. So guys, I'm going to include those in the show notes, but just very quickly, I'll announce them here as well. Reliant-MGMT.com is the main site for Reliant Management Company. And you've got Reliant Investments, which is the investment arm of their business. So ReliantInvestments.com. And then also, Kris also has his own personal website with tons of great information there. It's KrisBenson.com. And that's Kris with a K, K-R-I-S, Benson.com. And Kris, that's all we have, my friend, man. This has been a lot of fun. You had mentioned in the beginning, before we started the show, that we had met years back at the Joe Fairless conference. And so it's unfortunate that we haven't had you on prior to now, because it's been a couple of years since you've been in the space. And I wish we'd have connected earlier. But hey, now it's today, and we're here now, and we're sharing a bunch of great information. So I really appreciate you coming on the show, and look forward to following your progress. I wish you the best with Reliant. Sounds like it's a great company to work for. Lots of great things that you guys got going on there, and hopefully we'll bring you back on a year or two from now after you launch your first or second fund. You'll tell me that you made it into that top 10, which you guys are shooting for. I think that would be a very cool show to have. So this is the wrap, bud. You take care, okay? Until next time.
Have a great day.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.